silver's down 50% from its peak. Let's call it $62, $63. I don't want to hold gold. I don't want to hold silver, but people have been taking money out of gold and silver to put into the fastest moving assets. Data centers, silicon, AI. Gold is around just a tad over $4,000 as we speak. I would much rather be a buyer of gold at 4,400 than at 4,000. Now that may be hard to understand, but when it's at 4,400, you've got a feeling that it's now moving in the right direction. We're in a silver shortage, but at least you've got in at reasonable prices compared with where it will probably be. And I don't think that the all-time high we saw of 125 is where it's going to stop. The silver miners have underperformed. They've become overly pessimistic in the light of the recent fall in the silver price. So that means to me, if you're buying into silver miners today, you're getting it at what seems like at a time when people are overly pessimistic. In the long run, I'm very confident that we'll go a lot higher.
First, the elephant in the room is obviously the silver price collapsing and gold price collapsing as we speak. What is your take on the sentiment right now in the metal space?
Well, both are clearly in bear market territory now. They're down more than 20% from their peaks. And in fact, silver's down 50% and something from its peak. So the peak was $125. It's now, let's call it $62, $63. I mean, maybe it'll be $1 different when you publish this video. The thing which is causing the price, or which everybody says is causing the price fall, has been the prospect of higher interest rates due to higher inflation, and the higher inflation is caused by the war. So, traditionally we look at political crisis as potentially being good for precious metals, although in my career I haven't really seen any strong evidence of that. It's that we're not back in 1945 where people had to fill their pockets with gold and cross the border. But despite the political tensions, they are causing the higher oil price, and the higher oil price will feed through to higher inflation. And that basically means that the world is now expecting interest rates to rise. We've got a dead certainty of rises in Europe, the UK, and almost certainly in the United States later in this year, probably in December. So higher interest rates, at least the nominal higher interest rates, make people think, I don't want to hold gold, I don't want to hold silver because there's a carry cost, I'm earning nothing. I might as well go into short-term deposits and earn some money. The other side of the coin, I think, is that people have been, up until maybe a week ago, although that's not turned around in direction.
Gold and silver are being sold as if inflation suddenly became bullish for cash again, and that contradiction should make investors uncomfortable. As Clive Thompson points out here, markets are reacting to nominal rates while ignoring whether real purchasing power is actually improving. The official story says higher rates strengthen confidence, yet persistent inflation quietly taxes savers holding conventional assets. Precious metals weakness may reflect positioning pressure more than a collapse in long-term demand. For wealth protection investors, price weakness and thesis weakness are not always the same event. Next, Clive Thompson exposes why the rate narrative only works if investors ignore what inflation is still doing beneath the surface.
But people have been taking money out of gold and silver to put into the fastest moving assets. And the fastest moving assets have been everything to do with data centers, silicon, AI, all that sort of thing. So we've seen almost daily for the last few weeks, last month or so, almost daily, there's 2 or 3 stocks which got 10 or 20% on the back of some story. So a lot of people have been chasing that, saying, well, okay, I missed the last one. It's hurting. Gosh, I meant to buy this, or I meant to buy that. Now it's gone up 20%. So they're kind of running a little bit, trying to find the next one. And I think the money's been coming out of gold and silver miners and gold miners and going into the AI sector. Now, of course, that sector is, as we speak, looking like it's slowing down. It's up today, but it had a very bad day yesterday. So air looks like it's coming out of the bag a little bit. I could perhaps talk about that in a minute or two as to why I think we might have seen the best of it.
It does seem like we're seeing multiple factors here as you analyze that the prospect for higher interest rates is pushing the market down and gold and silver down. And we saw that high inflation number here in the US of 4%, the highest we've seen in years. Kind of laughable because obviously it's higher than that, but as the official number. And then we have as well, we have the SpaceX IPO coming out just tomorrow. We're recording this on June 11th here. And that you've mentioned is really sucking liquidity out of the market. Can you expand on that?
So the amount of liquidity being sucked out of the stock market relative to the size of the stock market is not very large at all.
Markets kept rising, but liquidity started concentrating into fewer names. And that pattern rarely ends with broad prosperity. According to Clive Thompson, capital rotation out of metals and into AI may say more about investor urgency than conviction. When people abandon protection assets to chase momentum, institutions often use that enthusiasm to rebalance quietly in the background. Retail celebrates headlines while liquidity conditions tighten underneath. That matters because concentrated gains can reverse faster than diversified wealth compounds. Next, Clive Thompson reveals the hidden timing signal showing when momentum trades begin feeding capital back into hard assets.
It's tiny, but it's at the margin, and we're still talking some $250 billion of applications for this $75 billion issue. So it's quite likely that people have raised cash to the tune of $250 billion to go into this issue. Now, it's not like $250 billion is a big amount relative to the total, but at the margin, someone is being sold stock when we're already in a rather overbought situation. So this sector, the AI sector, the large mega cap companies were rather overbought, meaning now there's sellers of some of those stocks trying to sell those stocks into an already overbought market. So there's a sort of reluctance from other people to buy the stocks off the sellers, which is why the stocks have been going down. But I think what's good, we will see how it develops, because once people have got their SpaceX shares, things will have settled down. I suppose the money probably will head back where it started from. Obviously, the nice thing would be if it goes in the direction of gold or silver. We don't see any evidence of that happening yet.
As we mentioned at the top of this interview, sentiment is extremely low in the precious metal space, where I am seeing on the retail side a little bit more action, people trying to buy the dip at the moment. But do you anticipate that we could be going lower before things get better? Or what is your outlook for especially silver, but also gold?
In the long run, I'm very confident that we'll go a lot higher. All the factors to drive the gold price, and for other reasons, the silver price higher, are still in place. Nothing's gone away. But one thing they used to say in Wall Street is you never fight the tape. And the tape is going down.
The same liquidity pattern appeared before multiple corrections. Enthusiasm peaks exactly when cash quietly leaves the broader market. What Clive Thompson is highlighting is that even small reallocations matter when positioning is crowded and valuations are stretched. $250 billion chasing one narrative can distort pricing far beyond the headline number. Metals investors should notice that sentiment collapses often arrive before fundamentals do. Portfolio damage usually comes from reacting late, not being early. Next, Clive Thompson unravels why extreme pessimism in metals may be signaling something very different beneath the surface.
So gold is around just a tad over $4,000 as we speak. I would much rather be a buyer of gold at 4,400 than at 4,000. Now that may be hard to understand, but when it's at 4,400, you've got a feeling that it's now moving in the right direction. And I don't want it to go to 4,400 tomorrow. I want it to gradually grind up there until I say, gosh, I'm missing out on this. I got to get in. So this is the saucer. We're going down the saucer. We don't know if we're at the bottom of the saucer. Might be there, might be there, might be there, or we might be at it. But then I want to be actually getting a feeling I'm going up the other side. Now, there's no maths or chart you could look at to tell you exactly when you're there. You can only get a feeling for it. But right now, my feeling is that If you're a stacker, as I am, it's a great move to keep buying little by little by little. But this is for those people who are sort of saying, I'm already at my peak of silver and I want more. I wouldn't go overweight in it at the moment. I'd wait for it to go a bit lower if it does and stack up. And if it doesn't, you're fine because you've got some silver already. But if you've got no silver, definitely start buying. That's my view. But that's not a prediction it's going higher tomorrow. We don't know that. But the point is, if you stack slowly but surely, you will catch the bottom of the saucer wherever it is. So we might be here, we might be there, or we're not yet, but we might be going up the other side.
The most expensive investment decisions are usually made when people demand certainty before acting. Clive Thompson's argument suggests that waiting for emotional confirmation often means paying materially higher prices later. Institutions accumulate into uncertainty because they manage risk differently than retail investors chasing trend validation. Dollar cost accumulation is less about prediction and more about surviving imperfect timing. Protecting purchasing power rarely feels comfortable at the point of entry. Next, Clive Thompson reveals why the search for the perfect bottom may be the biggest hidden cost in metals investing.
You've mentioned people who are looking to, buy the dip and time the market can sometimes it's difficult, and it also might not be the right way to think about it. The dollar cost averaging might be better, because you mentioned in a recent article you wrote that if you're wanting to buy the dip, there will probably there might not be new all-time lows. There are almost certainly, we can't guarantee this, but in your view, almost certainly going to be many, many, many more all-time highs. So if I remember back when silver was, just breaking above 50, it came down a little bit. A lot of analysts were saying it's going to 40, right? And I was like, oh, maybe I'll wait to 40. Well, it didn't turn back, right? So if we're at 60, 3 or whatnot today, and we're waiting for 50, if you don't already have a good position or where you want to be, where you're comfortable at, waiting for the perfect time to put everything in, you might not get that opportunity.
I mean, that would be wonderful. We could put everything in at the bottom. But to be honest with you, I know of nobody who ever bought anything at the bottom, or of anybody who sold everything at the top. The way to play the game is you put some in and you put some in. So if you buy some at 50 and then at 45 and then at 40, then at 45, then at 50, then at 60, then at 70, then at 80, yes, you might be quite annoyed that you didn't buy the whole lot at 40. And you'd be a little bit annoyed that you paid for something at 60 when it's now 80 and you could have paid 40.
The market rewards discipline far more often than it rewards precision. This is where Clive Thompson's thesis shifts from price prediction into behavioral risk management. Investors waiting for dramatic pullbacks often discover the market only offered discomfort, not bargains. Wall Street sells timing because it feels intelligent. Compounding usually looks repetitive and boring. Missing exposure entirely can become more damaging than imperfect entries. Next, Clive Thompson exposes why investors obsess over entry prices while institutions obsess over positioning size.
But at least you've got in at reasonable prices compared with where it will probably be. And I don't think that the all-time high we saw of 125 is where it's going to stop. There are plenty of people out there who think they know what they're saying, who are printing prices higher than the all-time high even this year. I'm hoping they're right. But what I can say is this: we're in a silver shortage. That's confirmed by the Silver Institute, where they're forecasting a bigger deficit in 2026 than there was in 2025. That deficit has to come from somewhere, and the only way it can come from somewhere is from sellers. So it's not going to come out of the mines, because the mines aren't producing enough. It's got to come from sellers of ETFs, sellers of physical bars or coins or recycled silver. And the way, although every ounce on the planet has got its price, and that price does move around according to how people feel, to get that silver to meet the demand, at some point, silver has to start moving higher. And when it starts moving higher, I think that becomes self-fulfilling. Therefore, people start to move their target price where I'm going to sell. So those who are willing to sell at 80 today are probably going to move their target price to 85. And so on. And then when it gets to near to 85, they'll move it up, because the momentum itself changes the way people think about what their target is. So on the way down, people gradually lower their target to 10 or 20% above the present price. But on the way up, they tend to keep their target 10 or 20% above where it is on the way up. The silver price really has to rise to suck that silver out for the purposes of the industrial needs.
A shortage only matters when sellers stop believing current prices are enough. As Clive Thompson points out here, deficits do not automatically create rallies unless holders refuse to release supply. That creates a feedback loop institutions monitor closely because psychology changes faster than production. Investors should remember industrial demand does not negotiate with narratives forever. The risk is not missing the exact low, but misunderstanding how repricing begins. Next, Clive Thompson reveals the contradiction between physical demand growth and paper market expectations.
You recently did a study on silver miners and how, when they released their results, how their stock price reacted to that. And one of the things that people have been talking about for quite a while is as silver has gone up from its low of $20 or so to $120, ever since it was $30, $40, $50. These silver miners are making huge profits, and it doesn't necessarily. It's great if silver is at 120, but $60 silver, $50 silver, that's still fantastic for a lot of these miners. And a lot of analysts you found were probably not factoring this in. They were underpricing these stocks. And then when results, when revenue was released and all that, they were shocked and prices went up. I think you had mentioned on average about 10% over that period. So can you expand on what you studied there, and then what do you forecast for the future for a lot of these miners?
Sure. So we've had the result. I've looked at all the results, or the last results, of the top 36 miners. For that I used the SIL, the Global X Silver Miners ETF, to choose which were the top ones. So I chose the largest holdings by size. So that, broadly speaking, is the largest companies. What I discovered was that and I reduced the database from 35 to only 16. The reason I reduced it to 16 was I eliminated all the loss-making companies, and I eliminated all the companies with price-earnings ratios in the sky. In other words, everything with a price-earnings ratio above 26 times. So out of the top miners, and most of these were really at the top of the pile.
Markets love growth stories until real earnings start showing up in the wrong sector. According to Clive Thompson, profitable silver miners may have been underestimated even while commodity prices stayed historically strong. That raises an uncomfortable question. If earnings improve and valuations remain compressed, what exactly is the market pricing in? Retail often hears volatility, while institutions study operating leverage. Mispricing rarely announces itself in advance. Next, Clive Thompson exposes why analyst expectations may be lagging the economics miners are already reporting.
There were 16 companies which have a price-earnings ratio below 26. I looked at the price before they announced their results and the price after they announced their results, and most of them went up on the results announcement. So I thought, what if I'd bought every single one of them exactly 7 days before the results were announced and sold it exactly 7 days after the results were announced? And the conclusion, I've got it on my screen in front of me, and everyone can go and look at this on my webpage. It's on clivethompson.com, and you scroll down to the bottom, you'll see a link to it. So you can see the numbers, you can see everything there. But what I discovered is, on average, you would have made a profit of 11.49% buying 7 days before and selling 7 days afterwards. And that is because those miners across the board were producing results which were mostly better than expected. Out of the 16 companies, only 3 went down. That means 13 went up. And of the ones which went up, a lot of them went up by a lot. I'm looking at numbers, almost all of them double digits. So if I just run my eye down the percentages, the first one 13.95, then 7, then 14.58, then 22.27, then there was a minus 40. That's one of the 3 which lost. Plus 19, plus 22, plus 20, minus 20, because that's the second loss, and 23.8, and so on. So we've got a lot of double-digit gains averaging out, including the losses, at 11.49% profit. Now, what does that mean for the results coming up in June? So the next set of results will be for the quarter ended June.
When earnings surprise repeatedly, the issue may not be performance. It may be disbelief. What Clive Thompson is highlighting is that analysts can stay cautious long after operating reality changes underneath them. Markets frequently reprice in bursts because expectations adjust slower than fundamentals. Investors protecting capital should watch earnings quality, not headline excitement. Momentum attracts attention, but cash flow eventually attracts capital. Next, Clive Thompson unravels whether the next reporting cycle could force a reassessment across the sector.
Or in some cases for the half year ended June. All those profits we already can anticipate will be much higher than they were a year ago, because the average silver price over the last 3 months and 6 months and 12 months has been a lot higher than it was in the same quarter, the June quarter, 2025. That means the mining companies have been making much more profit this quarter than they made exactly a year ago. So they will be showing a year-on-year profit increase, which will be substantial. Revenue increase and profit increase, and I'm assuming almost every single one of them. What we don't know this, but I'm speculating that for those who want to take a chance, you look at the ones which are going to have the biggest profit increase, and there's a table on my website you can look at to see that. I'm speculating the ones with the biggest profits increases will be the ones which will move the most when those results are actually announced. Now, this is only speculation, but it'd be repeating what happened in Q1 for those companies. 13 out of 16 went up a lot, and perhaps a large percentage could go up again. No guarantee it's going to happen, but I think it was an interesting exercise to discover that the analysts were just too cautious at the end of the last quarter.
And for those who are bullish on silver long term, it is interesting to note that the price of a lot of these miners have fallen significantly since silver has cooled off here. So again, it seems like there is a good argument to be made that, the market is not pricing in these higher profits at these higher prices.
The market has become overly negative. I've measured the silver prices via the ETFs and via direct silver companies compared with the last time silver was at this price on the way up.
Sometimes the biggest risk is assuming the market has already priced everything in. Clive Thompson's argument suggests that profit expansion and sentiment collapse can exist simultaneously for longer than investors expect. If earnings accelerate while valuations compress, the eventual adjustment can be abrupt rather than gradual. Wealth preservation is not avoiding volatility. It is recognizing when pessimism becomes disconnected from cash generation. Next, Clive Thompson reveals the metric that may show whether miners are being priced for conditions that no longer exist.
If you held a portfolio of these companies, diversified, or the ETF, you would have less value today than you had at the last time the silver price was at this level when it was on the way up, and significantly less. So the silver miners have underperformed. They've become overly pessimistic in the light of the recent fall in the silver price. So that means to me, if you're buying into silver miners today, you're getting it at what seems like at a time when people are overly pessimistic. Doesn't mean to say it's the bottom. We don't know that. Nobody can tell you that. It might be, it might not be. But
markets are pricing silver miners as if margins disappeared, even while the underlying commodity remains far above old levels. This is where Clive Thompson's thesis shifts into a valuation question rather than a commodity call. Underperformance does not automatically mean opportunity, but it can signal expectations have become too one-sided. Investors should separate price damage from business deterioration before making decisions. Extreme pessimism has a history of arriving late.